Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last week we saw the US Federal Reserve pause on interest rates, but more hikes are in the offing. Well, at least we think they are. And in Australia, with a hot labour market and inflation still too high, economists expect the Reserve Bank to keep increasing interest rates. So what's it all mean for investors? Where are the opportunities in this environment, both here and overseas? Remember, this is general information only, and you should seek professional advice before making any investment decisions. Anto Joseph is the Chief Executive Officer and founder of investment fintech Stropro. Anto, welcome to Fear and Greed.
Thank you, Sean. It's good to be here.
So how would you characterise the investment environment right now?
Yeah, it's actually interesting that you sort of mentioned about the Fed pausing. I think even though US inflation is cooling and the S&P 500 is at sort of 13-month high, economic uncertainty is still very much persisting, particularly because it's challenging a lot of what the Fed decisions might look like. Core inflation exceeded expectations at 5.3%. So I think we're still, fairly a long way away from that Fed Reserve target of 2%. But to characterize the environment, to sort of answer that question, I think there are three things that are really vital what investors are thinking about. And that's really, there's a clarity of market direction. The best reflection of this is probably seen in the trading volume we saw in the Australian equity market, which was down 30% year on year in May. And volatility has remained very low. And there's less buyers in the market at the moment.
Is that because of a lack of certainty? Is that what triggers that?
I would say that it's, very much a lack of certainty. I think you can look at even the Fed as an example where, terminal rate forecasts are still struggling to reach a consensus. The point at which interest rate curve really reflects the highest point of future rate expectations. It's not very clear what's happening. As you mentioned, Citibank is forecasting up to 2 more rate hikes further this year, but that current pause might, sort of suggest otherwise. More interestingly, I think what investors tend to forget a little bit about is the market impact of the rate hikes we've already seen. It tends to be a 15 to 20 month lag on the impact of fiscal tightening, which will be only felt in sort of medium to longer term. But the other thing that's very interesting is, I guess, this liquidity cliff conversation. That passing of that debt ceiling in the US obviously has led to a bit of a rally in US rates. It's because the US Treasury has had to rapidly raise debt to maintain liquidity, which means that the Federal Reserve balance sheet is likely to shrink. And so you're seeing this forecast of a potentially $1 trillion withdrawal of liquidity between now and July, which could bring back a little bit of volatility into the market and maybe lead to a bit of a pullback overall.
Okay, that's the US, and we are always very focused on the US. I just want to ask you, Anto, about Japan, because that's had quite a run in recent months.
Yeah, absolutely. And, I think that's very interesting. At Stropro, one of the things that we do is we work with a panel of investment banks. So we understand where a lot of investors, particularly institutional flow, is moving. And the Japanese financial system, which we've observed over the last sort of 6 months, has been the healthiest it's been in the last 40 years. The largest Japanese banks have strong retail deposit bases. There's higher liquidity coverage than US banks at the moment. Year to date, the Japanese market's up 18.5%. It's at a 30-year high. And I think there's a few contributing factors that sort of lead to that. One, the weaker yen has also strengthened exports, which is important as a GDP driver. The Bank of Japan is maintaining a fairly dovish stance to try and heat up the economy. But what we saw at the start of the year, which is quite interesting, is that the Tokyo Stock Exchange has increased some of the regulatory and reporting requirements for Japanese equity market, which address some of the historic inefficiencies that existed there, which means that you're likely going to see a little bit more value creation in the equity market as that cleanup happens. And so balance sheets of Japanese companies at the moment seem to be stronger than their global counterparts. And that's where you've seen a significant amount of flow move into public markets like Japan. But yeah, on the other side, when you talk about where flow's going, a lot of high net worth investors are sort of veering away from that 60-40 split between equity and bonds and leaning more towards alternatives.
Stay with me, Anto. We'll be back in a minute. I'm speaking to Anto Joseph, CEO and founder of investment fintech StroPro. You do a lot of work with ultra high net worth individuals, or you have you have data about where they are putting their money. When you're talking about alternatives, just define that for us and then maybe dive a little deeper into what they're interested in.
Yeah, absolutely. And I think that's a great place to start. Alternative investments can be quite broad, but they typically are anything outside of those traditional asset classes, equities, bonds, property. And so they can include things like private equity, private debt or asset-backed debt or private credit, hedge funds, venture capital, private equity, and structured investments. So the primary objective of an alternative investment is to provide investors non-correlated market exposure to enhance diversification in the portfolio. So I think alternatives are very much on the rise in that sort of ultra high net worth segment. We're seeing that, in portfolios globally, the average is sort of 26% equity, 17% bonds, and the rest being allocated to alternatives, whether that be property, private equity, venture capital. So there's clearly a strong trend to have lower correlation to the market or non-correlated market exposure.
So the obvious question, why?
Yeah, so I think really here it's because you're probably, as I mentioned before, there's less buyers in the market. And I think if you talk to most institutional commentators, they'll talk to you about this sort of subdued equity market and subdued growth environment, at least over the next 12, 24 months. And typically where alternatives will play really well is in these types of sideways markets or highly volatile markets. They'll try to provide sort of consistent returns, without relying on a bull market. So we're seeing this flight to alternatives, but more importantly, a flight to quality alternatives. So typically assets like venture capital, private equity, they need to be held fairly long term and have liquidity challenges. What we're seeing right at the moment is we want non-correlated market exposure, but we also want this kind of nuance of liquidity. And so what we're seeing, particularly in Asia, US, and Europe, is this appetite towards structured products. And structured products or structured investments have been financial instruments that have been really customized to meet specific investor objectives, and they're packaged up through a combination of bonds and derivatives by large institutional banks. But you're seeing this huge appetite for structured products because they can be really tailored around any sort of market scenario or investor objective.
Okay, so you're going to have to break that down even further for people like me. So what you're talking about, it might be an asset that has some inflation protection built in. It's got a floor in it. So if an asset price falls below something, it might trigger a sale or something. It's kind of, it's almost like taking a bunch of things out of the toolkit and creating a product around that using derivative products and hedging. Am I right in that?
Yeah, you've pretty much nailed it. Structured product, by virtue of the term structuring, you're structuring a series of components together. And so firstly, they're typically issued by a global investment bank and can be linked to any listed asset class predominantly across the world. And so if you think about we work with sort of 9 institutional trading teams, but whether a client is looking to get enhanced income and mitigate some of that downside risk, that can be a structured product or investment that we can put together. If a client's really concerned or an investor's concerned about, I really have no certainty of where the market's going, I'd rather protect against maybe a bearish view, you can provide strategies which are 100% capital protected, but can provide some layer of exposure to the market. Or you can structure a product if you have a growth mindset to take advantage of that and participate in growth while still maintaining some level of protection. So they're highly versatile, but can be really structured around any objective a customer has, but also gives you that advantage of having liquidity as well.
Okay, so a couple of questions in all this. So we're getting into structured products and high net worth individuals pushing into alternatives. First question is Is there a concern when so much money is going into alternatives and not in the traditional bond equity area? Is that a concern, just the fact that so much money is going into that? And the second question is those products themselves, they're not always that easy to understand.
Yes, of course. And to answer your first question, within that alternatives bucket, there's so many vehicles to invest. So you can actually diversify quite a fair bit across alts. So whether that be, buying a hedge fund or a private equity fund or a commodity fund, ESG, impact, there's so much in that sort of umbrella that an investor can diversify into. So regardless of a large portion of capital globally moving to alts, it's actually being diversified well. And really, the question comes down to, do you want liquidity or not? And then choosing the right vehicle. What's the investor objective? And is that the right vehicle? So you still have plenty of options of diversification there. In terms of the complexity of understanding around a lot of alts, that's why a lot of platforms like us exist in the market, because we've understood that, one, alternatives are complex and can be complex because there's such a myriad of options globally. But for Australian investors particularly, this is fairly new. The average high net worth clients or investor in Australia invests roughly around 12% of their portfolio towards alternatives. And that was by a premium report, wealth report that sort of came out almost a year and a bit ago. That's on the rise. But unfortunately, the education needs to kind of match with the growth of that sector. And so platforms like us are designed to provide educational material, content, which is relevant to the alts market, which will help facilitate that process a lot easier. But yes, there is an education curve that needs to be met.
Well, I've been educated today, Anto. Thank you very much for talking to Fear and Greed.
Pleasure, Sean. Thank you.
That was Anto Joseph, CEO and founder of investment fintech StroPro. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.